Now, the US has lost its perfect credit rating on ratings firm Moody's expressed concern over the government's ability to pay back its debt. In lowering the US rating from AAA to AA1, Moody's noted that successive US administrations had failed to reverse ballooning deficits and interest costs. A AAA rating signifies a country's highest possible credit reliability and indicates it is considered to be in very good financial health. US futures, a gauge of how Wall Street will open on Monday, are trading lower on the back of this news. Markets in Asia are also trading lower. Now, for more on reaction to this, I'm joined by Jameel Ahmad, a chief analyst at GTC. Jameel, what's the key thing to understand about this downgrade in rating, given that it's the third rating agency to do so?
It's exactly that, Steve. And actually, if you look at what's happened over this weekend, it's actually followed suit from Standard & Poor's, which was just over 13 years ago, and Fitch Ratings, that was 2 years ago, where both have downgraded the ratings in similar fashion. I would actually look at this news as more of a news headline rather than something that's really going to be market shifting. If you look at the lower financial markets that we have pointed on in the early hours of trade for this week, we have to take into account that last week was a very strong week for US markets, where the S&P 500 moved up around 5%. Then you have the NASDAQ also moving up about 6 or 7%. After that, somewhat of a trade breakthrough between US and China, where they reduced the tariffs for the next 90 days. But if you look as well at some of the weekend comments that are coming through from the Treasury Secretary, it does seem like the United States are willing to negotiate even harder with some trading partners, with the warning that tariffs will go up back towards the April 2nd levels, which were famously known as Liberation Day, if some of the trading partners do not play fair in negotiations.
Yeah, so how do you see, just moving on then to the current state of play with the US tariffs, are they starting to be felt in tangible ways by consumers?
I think that at the moment we haven't yet seen the impact, because these tariffs only came into place somewhat in April, and of course they've been reversed or been rolled back. And it would take a couple of months until we start to see the inflation data that suggests whether these tariffs are impacting consumers. Where we might be able to see some sort of an indicator is with some of the PMI readings, because we start to see industries are rolling back on some of their activity, then that would suggest that tariffs are playing a role. But right now, we are still playing poker. It looks like we're just negotiating. If you look at some of the more recent moves in the United States, where, of course, we're rolling back tariffs once again, it does suggest that we're here to have a deal. And once those deals start to be signed, then market sentiment will continue to rebound as it did last week.
And just very quickly, back on Moody's, any wider implications?
Maybe for the reputation, but again, we've been looking out for the fiscal deficit and the government debt to GDP ratios for some time. So this news isn't a complete surprise. It was just the timing of the news. Of course, it's not good for the US reputation, but overall, when it comes to larger market impacts and so forth, we've got our focus elsewhere.
Jameel, thanks very much for your time. Jameel Ahmad, Chief Analyst at GTC.